terminal where on one screen, U.S. warships are actively turning away merchant vessels in a heavily mined Middle Eastern strait.
Right.
And yet, on the very next screen, the NASDAQ is just skyrocketing by nearly 400 points. I mean, how do those two completely conflicting realities exist at the exact same time? Welcome to Market Recap. I'm Daniel.
And I'm Mira.
Today is Friday, April 24, 2026.
Yeah, and for those of you listening, we're looking at a market that has just pulled off a truly massive V-shaped recovery rally.
Which basically completely erased the steep sell-off we saw back in March.
Exactly.
Just to set the baseline for you today, the S&P 500 closed up 0.8% at 7,165 points of a rate.
And the NASDAQ surged 1.6% to close at 24,836.60.
Yeah, it's a remarkable turnaround, especially given, the sheer physical context of the last few weeks.
It really is.
So that brings us to the core mission for today's deep dive. We're going to explore this intense macroeconomic tug-of-war currently pulling at the markets.
Right. Because on one side, you have this severe Middle East geopolitical tension acting as a massive drag on the global economy.
And on the other side, you have the gravity-defying artificial intelligence capital expenditure boom acting as basically a powerful rocket engine.
Yeah. But before we really get into the mechanics of those opposing forces, we do need to explicitly state that this deep dive is for market context and discussion only.
Right. This is not personal investment advice or an investment recommendation.
Exactly. And also, because our sources today contain highly politically charged content regarding the ongoing international conflicts, we want to make it absolutely clear to you, the listener, that we are not endorsing the viewpoints of the content.
We are not taking sides.
No, we are simply trying to impartially report and convey the ideas contained in the original source material so you can understand the baseline that the markets are operating against.
Which leads us directly to our first major question for today. What set the stage before the U.S. session?
Well, to understand the morning's incredible pre-market price action, we really have to look at the carryover from Thursday, April 23rd.
Yeah, the backdrop heading into today's pre-market hours was intensely stressful on a purely physical level.
I mean, if you look at the supply chain data, it is staggering.
Yeah.
We've been dealing with a U.S. ironclad naval blockade in the Strait of Hormuz.
And for anyone tracking global logistics, that is one of the most critical maritime choke points on the planet.
Right. And just yesterday, 34 merchant ships had to be physically turned around by U.S. forces.
34.
Yeah. And on top of that, we had credible reports of Iran deploying more explosive mines in the waterway.
So the tension was just palpable. Global energy markets were basically pricing in a literal worst-case scenario for shipping lanes.
But then we get to the massive pre-market catalyst that completely flipped the scripts.
Oh, the diplomatic talks.
Right. At 8:38 a.m. Eastern Time this morning, reports began to emerge that indirect diplomatic negotiations were actively kicking off in Islamabad, Pakistan.
Which is fascinating timing. I mean, the details on this are striking. Iranian Foreign Minister Araghchi actually traveled to Pakistan.
Wow.
And U.S. President Trump dispatched two envoys, Steve Witkoff and Jared Kushner. The reports indicate they're negotiating over the status of the Strait of Hormuz and enriched uranium.
So the core of the potential deal seems to revolve around Iranian concessions in the region in exchange for American flexibility regarding their frozen funds.
Okay, so here is where I have to push back a little bit on the market's reaction.
Sure, go ahead.
Because as a market practitioner, when I see equities rally this hard and this fast on just the initial whisper of talks, I have to ask, is the market way too eager to price in a neat, clean diplomatic resolution?
You think they're jumping the gun?
Yeah. I mean, if we look at this through a game theoretic lens, isn't this just geopolitical brinkmanship as game theory leverage?
Absolutely.
Both sides are using maximum pressure mines in the water versus naval blockades simply to negotiate. That kind of posturing usually drags on much longer than the market's quick sigh of relief implies.
Well, that is a very fair critique. And, if we look at the sources neutrally, the physical situation remains highly fluid. The naval blockade is still physically in place.
Right. The shipping lanes are not magically cleared.
No, they aren't. So pricing in an immediate return to normal trade flows is absolutely premature.
Right.
However, from a purely mechanical market perspective, just the initiation of formal dialogue takes the absolute worst-case tail risks, like a broader regional war, off the table.
Uh,
And that immediately deflates the equity risk premium.
which totally explains the massive pre-market bid in equities. But, that wasn't the only thing providing relief before the opening bell.
No, it wasn't.
At 5:14 a.m. Eastern Time, another major report dropped, this time regarding the Federal Reserve.
Right.
Reports indicated that the Department of Justice is expected to drop its criminal probe into Fed Chair Jerome Powell.
And we have to look at the mechanics of why that matters so much for traders.
Yep.
This is a classic example of how institutional uncertainty affects asset pricing.
Markets absolutely loathe uncertainty around central bank leadership.
They do. When you're trying to map out the future path of interest rates, you need to know who is actually setting the policy.
Right. So when the news broke that the probe was likely ending, you immediately saw Treasury yields and the U.S. dollar dip.
Because without the overhang of that legal drama at the Fed, traders started pricing in a smoother, perhaps quicker path to policy easing.
Relieving that institutional stress was just a huge green light for risk assets.
Yeah.
But while the DOJ was backing off, we also had some strategic defensive moves happening behind the scenes on a global scale.
Oh, yes. At 10:14 a.m. Eastern Time, Treasury Secretary Scott Bessent was out aggressively pushing for expanded dollar swap lines with Gulf and Asian allies.
And the mechanics of those swap lines are so crucial to understand right now.
They really are. Essentially, the Treasury is trying to create new, permanent global dollar funding centers.
How does that play out mechanically?
Well, here's how it works. In times of severe geopolitical stress, foreign institutions get nervous. They need U.S. dollars because the dollar is the ultimate safe haven.
Okay.
Normally, to get those dollars, they might have to sell off massive amounts of U.S. Treasury bonds in a disorderly panic.
Right. And if foreign central banks start dumping treasuries in a fire sale, U.S. yields spike, borrowing costs explode, and it just wreaks havoc on the domestic economy.
Precisely. So by expanding these swap lines, Bessent is basically telling these foreign allies, hey, don't sell your treasuries.
We will swap you the U.S. dollars you need directly.
Exactly. Using your own currency as collateral. It provides a massive liquidity backstop.
Which prevents fire sales of U.S. assets?
Yes, and strongly reinforces the dominance of the dollar as the global reserve currency.
So if we look at the morning as a whole, before the U.S. trading day even really got going, we had diplomatic talks in Pakistan easing the energy panic.
The DOJ stepping back from the Fed chair, relieving institutional anxiety.
And the Treasury actively fortifying global dollar liquidity. All of those headlines worked together to aggressively deflate the equity risk premium.
It fundamentally altered the baseline before a single stock was traded in New York.
It really did. So we're going to take a short break, and when we come back, we'll dive into how the actual trading day played out.
Sounds good.
All right, welcome back. Which brings us to the physical reality of the trading day itself and our second major question. What moved markets during U.S. trading hours?
Well, once the bell rang, we really saw the markets as a two-speed regime today.
Yeah, the intraday swings were incredibly significant.
Very. I mean, if you look at the S&P 500 futures, they actually dipped down to a low of 7,135.50 early on.
Before catching a massive bid and rebounding all the way to 7,196.25.
Right. But the real volatility, the truly wild swings that dictated the broader macro narrative, were in the energy complex.
WTI crude oil plunged from an intraday high of $97.85 all the way down to $92.68.
Which is just a massive move.
Huge, before eventually settling at $94.91.
And, that crude oil plunge is the direct causal link to the broader equity rally.
Right, because that drop in oil prices was the market mechanically pricing in the news from Islamabad.
Less fear of a closed Strait of Hormuz means lower forward expectations for oil prices.
Which theoretically means less fear of a broader inflation spike.
Yes, theoretically.
Yeah, theoretically. But if we dig into the actual data released this morning, the inflation fear isn't entirely gone, is it?
At all.
Because at 10 a.m. Eastern Time, the University of Michigan released its final April Consumer Sentiment Index.
Right.
The headline number actually ticked up slightly to 49.8, but the internals were a massive red flag.
They absolutely were. The hidden danger in that report was the inflation expectations data. The one-year inflation expectations stubbornly held at 4.7%, and the five-year outlook held firm at 3.5%.
So what that tells us is that regardless of diplomatic talks today, consumers out in the real world simply do not believe prices are coming down.
Exactly. It's exactly what we mean when we talk about energy shocks as a lagged tax.
Oh, right. Think about it. Even if crude oil drops $5 today because of diplomatic whispers, the prior weeks of high energy prices have already seeped into the real economy.
It acts like a tax on the consumer at the pump and at the grocery store.
And because those inflation expectations are sticky, consumers demand higher wages, businesses keep raising prices, and it paralyzes the Federal Reserve.
Because the Fed cannot responsibly cut interest rates aggressively if the public expects 4.7% inflation over the next year.
Right.
And because those expectations are stuck, it keeps the discount rate as gravity incredibly heavy on the non-tech parts of the market. High rates drag down valuations for everyday companies that rely on borrowing to grow.
Yeah, but while the market was trying to digest that deeply sticky consumer inflation data, the geopolitical situation was simultaneously evolving on the financial front.
Oh, yes. At 12:14 p.m. Eastern Time, the U.S. Treasury announced a major escalation in sanctions.
They explicitly froze $344 million in cryptocurrency that was tied to Iranian wallets.
And furthermore, they sanctioned a Chinese independent teapot refinery called Hengli Petrochemical for buying Iranian oil.
This is a fascinating mechanical shift. It shows that the U.S. is weaponizing financial blockades right alongside the physical naval blockade.
Exactly. By freezing crypto wallets, they are aggressively cutting off the digital and financial oxygen that funds these operations outside of the traditional banking system.
But by sanctioning Hengli Petrochemical, the Treasury isn't just squeezing Iran. They are functionally throwing sand into the gears of U.S.-China trade.
They are.
Teapot refineries are independent, yes, but they are crucial to China's internal energy consumption. How is the market not pricing in that secondary friction?
Well, it is a highly aggressive maneuver that deeply complicates global supply chains. When you sanction a Chinese entity, even an independent one, you invite reciprocal friction.
You force Chinese financial institutions to either comply with U.S. Treasury demands or risk being cut off from the dollar system themselves.
Right. It adds a whole new layer of geopolitical risk that the broader market largely ignored today.
So, summarizing the regular trading hours, the market had to digest this intense push and pull. We had incredibly sticky consumer inflation data paralyzing the Fed.
And aggressive new financial sanctions threatening to create secondary trade wars.
But all of that fundamental friction was ultimately overpowered by the massive plunge in crude oil prices.
Which allowed traders to just keep bidding up risk assets, particularly in the tech sector.
Right. So we're going to signal a short break here, and then we're going to dive into the corporate catalysts that supercharged that tech rally.
Perfect.
All right, welcome back. This brings us to our third core question for the deep dive. What were the major corporate events, and what do we need to watch next?
Well, to understand the sheer scale of the corporate action today, we actually have to briefly step back to a major carryover catalyst from after the close yesterday, April 23rd.
At 4:01 p.m. Eastern Time, the Intel earnings drop.
Exactly. Intel set a massive baseline for today's session. They reported double-digit year-over-year growth, specifically in their AI business segments.
Which triggered a massive 15% after-hour spike in their stock yesterday.
And effectively proved that the underlying fundamentals in the semiconductor space are still historically strong heading into Friday morning.
But the real jaw-dropper today, the headline that completely consumed the tape came at 11:50 a.m. Eastern Time.
The Google announcement.
An absolute mega deal. Google announced it plans to invest up to $40 billion in the AI startup Anthropic.
That starts with an initial $10 billion cash commitment.
Right. But crucially, and this is the part that really grounds this in the physical world, Google is committing to provide at least 5 gigawatts of computing power to Anthropic to train their next generation models.
We really need to pause and explain the physical reality of 5 gigawatts.
It's massive.
5 gigawatts is an astonishing amount of electricity. It's roughly the equivalent of powering several major metropolitan cities. Wow. It is AI capex as an existential arms race. When Google commits to 5 gigawatts, they aren't just writing a software check. No. They have to physically secure the land, secure the industrial-scale water cooling systems, buy thousands of tons of copper for the transformers.
And essentially hijack massive portions of the regional power grid.
Yes.
It's an infrastructure black hole. These tech hyperscalers are pouring billions into physical infrastructure, and they are acting completely independent of the macroeconomic cycle.
Absolutely.
I mean, they don't care about the University of Michigan Consumer Sentiment Report. They don't care about sticky inflation. They are playing a completely different game.
And they're not playing it alone. We saw a literal bidding war erupt across the entire sector today.
Right. DeepSeek unveiled a highly anticipated preview of their V4 model.
Microsoft immediately countered by making GPT 5.5 generally available on their Foundry platform.
And then Google and Microsoft reportedly entered a massive direct bidding war over the rights to use SoftBank's gigantic data center facility in Ohio.
Which exposes the vulnerability here. AI growth as a power grid bottleneck.
Yeah.
You can have all the cash in the world, you can have the smartest engineers, but if you can't physically plug your servers into a grid that can handle the load, your growth hits a hard physical wall.
That's why they're fighting over existing facilities in Ohio. Ohio is practically becoming the new Silicon Valley, not because of software talent, but simply because it has the heavy industrial power infrastructure these models require.
It's the ultimate example of big tech capex as an index floor.
It really is. The sheer scale of capital being deployed physically forces the broader indices upward, dragging the rest of the market with it.
Exactly.
You know, I have to say, looking at the sheer madness of today's tape, the warships, the billions in AI spending, the power grid bidding wars, it brings us to a rather absurd realization to close out the week.
Oh, I know exactly where you are going with this.
Yeah. Think about it. With the Nasdaq's massive 1.6% surge today, the only thing expanding faster than Google's $40 billion AI budget is our collective risk appetite.
It is entirely detached from the geopolitical reality.
Exactly. We have ironclad naval blockades, 34 ships turned around, and a literal crisis in the Strait of Hormuz.
Yeah.
Yet the market is out here partying like it's a tech boom just because we have much smarter chatbots.
Well, considering how sticky the negotiations in Islamabad might be, maybe they should send the chatbots.
Seriously. If only we could get OpenAI's new GPT 5.5 to negotiate the Middle East ceasefire in Pakistan, we'd probably hit Dow 50,000 by Monday morning.
Probably.
But until then, I guess we just pop some champagne for this V-shaped recovery and remember the golden rule of 2026. When in doubt, just blindly buy another semiconductor stock. Ding, ding, ding.
It is a fitting summary of the absolute euphoria we saw today. But looking past the champagne and the tech rallies, we have some highly critical, very tangible events to watch for the next session on Monday, April 27th.
Oh, right. What exactly is on the docket that could test this rally?
First, at 9:30 a.m. Central Time, we get the Dallas Fed Texas Manufacturing Outlook Survey.
Okay, so this is going to be a timely read on actual factory activity and prices paid.
Right. It will tell us if the inflation expectations we saw in the Michigan data are actively showing up in industrial supply chains.
And the bond market has a major test coming up as well, right?
Yes. The Treasury refunding auction slate is closing. We will get the final results for the 13-week and 26-week bills, as well as the 2-year and 5-year notes.
Which is absolutely crucial for assessing front-end duration risk.
Exactly. Essentially, it will show us exactly how many buyers are willing to absorb U.S. debt at current yields.
Which will tell us how the market is truly digesting the Fed's higher-for-longer stance regarding that sticky inflation.
Yep.
And what about the currency side? How do we know if Secretary Bessent's swap lines are actually working?
For that, we look to the afternoon. At 4:14 p.m. Eastern Time, the Federal Reserve will release the H1010 foreign exchange rates.
So this isn't just a list of numbers. It's basically the definitive scorecard for global currency stress.
It will be our direct check on the U.S. dollar's direction, and it will prove whether or not Bessent's swap line announcements successfully cooled down the panic buying of dollars abroad.
So plenty of hard economic data coming down the pipeline on Monday to test the validity of today's tech-fueled euphoria. But before we sign off for the weekend, I want to leave you, the listener, with a final thought to ponder.
Go ahead.
We've talked extensively today about how global equity markets are resting their entire weight on the idea that these tech giants will keep spending billions indefinitely.
Right.
The market is happily ignoring blocked shipping lanes in the Middle East, ignoring military standoffs, and completely shrugging off sticky 4.7% consumer inflation expectations because they believe AI spending will save the day.
Yeah, that big tech capex is an index floor.
But if that is the case, What happens to those gravity-defying valuation multiples if these heavily concentrated tech giants finally hit a hard physical limit on securing the massive gigawatts of electricity they need? What happens when the virtual world finally runs out of physical power?
Please share your thoughts on today's massive market tug-of-war and how you think that physical power grid bottleneck will ultimately play out down in the comments.